Right. Testing. 1, 2, 3. Testing. 1, 2, 3. G'day, mate. How are ya? How's your mum? You guys ready to go? It is a Wednesday, a wonderful Wednesday, in fact. It's Fed meeting day, a very important day on the calendar. Although every year I tell you the July Fed meeting is a dead meeting, it's still nonetheless an important meeting. So we gather here today for this thing called Forex. And I've been doing this for almost 20 years, so I'm here to help. Help me help you. So ask good questions, get involved, take notes, write things down, take notes, write things down, take notes, write things down. It's an important process. If you don't remember, then it never happened. You need to train yourself to remember the stuff I share with you. And if you can just grab onto one piece of information every single day, then over a long period of time, there's sort of a compound return. So this is why I ask you, on the recordings of the video, available just seconds after the live stream, to go in and document what you learned in the comments section. Think about it like, what is my key takeaway today? What's the one thing I want to try to hang on to in my gray matter? What's the thing I want to hang on to? And you write that. Today's key takeaway was blah, 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 blah. Or today I learned blah, 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 blah. Whatever small or large piece of information it is, document it, because now you're thinking about what's important to you, which means you store it somewhere. Plus you remember me telling you, so you store it somewhere else. You probably hear my voice, which means you store it somewhere else. But check this out. You actually store it on the cloud, because now you can go into the back office of your YouTube and search your comments and say, when was that thing I learned how to scalp the news? Where's that? What video did he talk about the high volatility event driven strategy? And you go into YouTube and you search your own comments and you say high volatility event driven strategy or news scalp, and it pulls up all the comments where you mention those things. You're like, oh, it was in February 3rd, 2018. Oh, awesome. Watch it again. See? So that's in your best interest. So without further ado, happy Wednesday, happy Fed Day. Let's get on with it. Let's go. Let me remind you that trading is risky and not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. So, hello, my name is Wayne McDonald. Yes, I've been a currency trader for almost 20 years, and before that, high-tech venture capital in the Silicon Valley. Well, and before that, I sat on a board of directors with George Soros for a nonprofit group that I worked for, I don't know, 4 years or something. So that's me in a nutshell. Feel free to ask questions, technically and fundamentally. I can do that. I can answer your fundamentals. I passed the Series 3 NFA exam or the CFTC exam. I don't know, gee whiz, 12 years ago or something. And that is sort of the license to offer fundamental analysis to institutional clients. Cool. That's not bad. I have a macroeconomics degree from Harvard and a master's in financial management. Cool. Studied alternative investing at Harvard Business School, cryptocurrencies at MIT, and now I'm wrapping up the algorithmic trading program at Oxford University. University of Oxford. So, what does that mean? You can ask me a lot of questions, and I can back it up with some real skills, real world experience, and formal education. So this is your opportunity basically to plug in for free, but by free, I mean no cost. But no cost of money. There's no monetary cost for being in this live stream, but there are some obligations. Things like bringing a positive attitude to the chat, treating the other Forex traders with dignity and respect, but also visiting tradersway.com and opening up a demo account. Yeah, that's an obligation. Sure. Now, some people say, well, Wayne, I'm not even sure which one to open up. There's things like an ECN. I don't know what that means. Well, that's great. An ECN, they enter your trades right into the interbanking system like all the other accounts. The difference is there's always a cost, right? Like things cost money, right? Nothing's for free. So with an ECN account, you basically pay something like a commission. You know, like when you see commercials like, oh, you can buy and sell stocks for only $5 or whatever. You know, there's a what I call a hard dollar fee. You pay a commission, but there's no spread. On the opposite but equal side is you have your variable account, which is my go-to. That's what I've always traded on, is a variable spread. And what that says is you don't pay a commission, but you pay a spread. That's normal in the Forex market. One key difference, though, because it's variable, is it's always trying to get you the best price, which is great. 99% of the time, that's great. However, some people like to scalp the news, for example. And in times like that, the spreads will widen. That's not your broker doing that. That's the interbanking system doing that. Okay? You have to reach farther to get someone to be on the other side of your trade. So that's normal. But if you're scalping, you don't like that because you want to know, like, look, if you're going to scalp and make 15 pips, if the spread goes from 2 pips to 8 pips, that's percentage-wise a lot, right? So you say, you know what? I just want to know it's going to be 3 pips or 2.5 pips every single time, no matter what. Or if there is no other person that close, then maybe you don't get filled, which is a way to protect your downside. That's a risk management tool. So for that, I would say get a fix. So again, variables, you pay through a spread, and you always get the best price available. Fixed, they take out the variability of the spread, and you always get the best spread. In particular, in times when spreads would be normal, that'd be high volatility or low volume. And then lastly, some people like ECNs because they don't want the spread and they're willing to pay a fee. To me, it ends up being about the same. It's a fixed, right? It's hard dollars versus soft dollars, whatever. So your way at Trader's Way with Trader's Way. So anyways, go to tradersway.com, bottom right-hand corner, open up that demo account, and that is an obligation for being here. Okay? Now, perhaps they'll earn your loyalty and respect. Huh? Think about it. When you're ready to trade real money, they will have already earned your loyalty and respect and your trust, and that's going to be the most important aspect of choosing a broker. Not how cheap they are, but how much loyalty they've earned. Should be follow George Soros or Jim Rogers or both. You don't mention Jim Rogers I worked with George Soros, so I didn't work with Jim Rogers. But hey, Jim Rogers is cool. I saw him speak once at a conference. He's good. He's a good speaker. I think I read one of his books. I can't remember. It might have been an audio book. I think it was one of my trips to China. I'm like, you know what? If I'm going to be on a 24-hour flight, maybe a Jim Rogers book on commodities would be good. But yeah, so, and I think he used to live in an apartment building I really like in New York City in Bryant Park. And I'm like, damn, he lives there? Really? But now he lives in Singapore, of course. So anyways, that's all I know about him. Okay, cool. So anyways, great. So we're here. We're currency traders. This is a big day in the year. This is the midpoint of the cycle, if you will. First half is now over. We're preparing for the second half of the year. And the Fed is still not going to do anything new except, they're not going to do anything new, but the one new thing they're going to do is change the language slightly. because they're setting everything up to announce a taper schedule in September. And by the way, we talked about this in February, and we talked about this last year. So this is nothing new to you. If you're a subscriber to this channel, you already know this stuff. You're so well informed and plugged in. So now we're kind of like watching the Fed set the tables, light the candles, dim the lights, turn on the mood music. They're getting ready for all of this. Okay? So last meeting, yes, they did say talk about tapering. By the way, I used those exact words well before that meeting. But what about the word transitory? Do you guys remember that last meeting? No. And if it was used, it was used probably during the Q&A when the media brought it up. So once again, they're not saying transitory, and they're going to make another small change to the language today to say, look, they are talking about the taper and how quick and how fast and how soon and all that kind of stuff. So no more transitory language, which means we have real inflation. I don't think they're going to talk about the recent GDP or the upcoming GDP. Hasn't even come out yet. I mean, it's so foregone conclusion. But this idea that once they start tapering, you could almost assume. Okay, so let me just draw over my charts for a second. Okay, so you have something like this, and we call this Y star. So Y equals GDP, by the way, nominal GDP. So that's just GDP, we'll call this. Okay, that's and by the way, that's supposed to be a straight line. Sorry. Let me fix this a little bit. Okay, there we go. Okay, now in this case, I'm not using star to say real GDP or nominal GDP, but potential GDP. That's what the economy should be doing over time. Okay. Now I've gone back 50 years of GDP data and averaged it out to 2.2% growth year after year after year. Hey, what's the Fed's target? 2%. I wonder why. Okay. Now, outside of this potential GDP, okay, we have business cycles. The business is booming, interest rates are high. The economy crashes, interest rates are low. The economy is booming, interest rates are high. The economy is crashed, interest rates are low. So let's call this section here, let's label this as recession. Okay? Okay? Now, one of the things I asked you to focus on a year ago was this part now, I'll make this dotted, that we had achieved the trough, the low of the cycle, and this is when the Fed said they were not going to go to negative interest rates. So I said that's the key moment, and that the thing you need to be using economic data for is analyzing where we are in this, okay, in this area, okay, and this is called, okay, let me label it over here. I got to get that color, okay, this is called the productivity gap. Okay. This is actual GDP. Okay. So I got to label that. Sorry. Okay. We'll call this actual Y. Of course, you could just call it, let's make this simple. Okay. We'll just call that GDP. And then this is GDP star. Okay, so GDP, the productivity gap is actual GDP and how far it is from potential GDP. And as we start to taper now, okay, this gap fills, and I think what the taper and then later on the raising under interest rates. So we'll just focus on the taper right now because that's what's coming up. The taper is suggesting that we are very nearly closed this gap. We might be here. And in anticipation of this, the Fed could taper, and then later on, so let me change colors yet again. Isn't it nice to have nice tools? Once we get above here, the Fed will raise interest rates. Okay? And isn't it interesting that actual long run GDP, not, I know you'll say, well, GDP is 8%. Dude, settle down. Okay? That's the transitory part. On the long run, okay, so our actual is approaching real, and we know that that's 2.2%, right? 2.2%, or let me do this darker. Okay, 2.2% actual GDP. Check this out. Right now, the 30-year bond is 2%. Even the 30-year bond is lower than potential GDP. And that just should not be the case. So it's really interesting. I think so a year ago I said, in this spot here, I said, process all your information and watch the Fed, because we're trying to anticipate the Fed, and the Fed's doing all the same stuff. So I think we're closing this gap very strongly. And the next thing to be watching as a foreign exchange trader are yields in the bond market. You may have remember that maybe, 8 months ago, I did a presentation about how if you worked at a bank, you would work in a department called Fixed Income, Commodities, and Currencies. FIC. Okay? And to a bank and to many hedge fund traders, Forex and bond market is they're kind of the same. Why do you buy a bond? Why do you buy a treasury? In many cases, and I tried to explain this in the summer cycle now, and part of seasonality, is that hedge funds, for example, have taken profit on investments they've made before the summer, and they're storing their cash in a treasury to maintain the liquidity, but to earn a higher interest rate, especially if they go triple cash, right? Triple leverage on a liquid treasury. So now they're earning 3% on their money annualized. And then when they come back, they want to then dump that. That's why the liquidity is important, so they don't lose money on that. And then, boom, they get back into their other thing, right? So this idea that it's close to money, okay? It's nearly money. You could call that what? M3, right? Near money. So anyway, so I think you're going to watch things like right now the 10-year is at 1.25. And I think, by the end of the year, I think I'd like this to be at or near 2%. Okay. And 2 years from now, we should be at 3%. Why? Well, then you could kind of push this up. So if this is 2 now, then the 30-year will be 3, and then 4. And in fact, I'd add a little bit more to that. So really a 30-year bond should be closer to 4.5 to 5. Okay. But we're not there yet. But I think you're going to start to see these things change. And a lot of that has to do with what the Fed's about to do next. Okay. And remember, if interest rates are rising in the United States, okay, your college professor told you the dollar would get strong. However, that's nonsense, and that's why he's a college professor and not a hedge fund manager. It's going to get weak. And I'll be there every step of the way, so please subscribe. What if it becomes like Japan's economy? They are not the same. The oldest developed country in the world is Japan. Does anyone know the second oldest? Germany. Isn't that amazing? Hey, both countries make wonderful cars. Okay? But they are not the same as the United States. This is demographic information or statistics that are really going to hurt their economies on the long run because old people are expensive. Okay? They're either not working. So how about somebody not working? Somebody not working has low productivity. They don't do anything. But they have high costs. Oh, I'm sick. I don't feel good. Oh, somebody has to bathe me. That's expensive. Okay? In Japan, they're like, well, I hope you saved money. In Germany, they're like, let us get somebody wipe your butt for you. Okay? So Japan forces people to save, and Germany will pay for it through high taxes. Either way, it gets done. You're either taxed by being forced to save, or you're taxed by the government taking money away from you and then paying you back someday. Okay, it's not good or bad. I mean, I would argue one is better than the other, but ultimately it's a decision-making process. Why, by the way, which one do you guys think I favor? The Japanese version of you better save your money and take care of yourself when you're old or you're screwed? Or Germany, where they're like, we're going to tax you at 55% tax your entire life. Oh, but when you're too old to work, we'll take care of you. Which one do you think I'm in favor of? Yeah. What would the Wayne do? Think of it not from Wayne's opinion, but from an economist. Okay? Okay, so if you're in, and by the way, the answer is Japan. I like the Japanese system. Okay, why? You are forced to save your own money instead of paying high taxes. Okay? Now, this is important. What does savings equal? Investment. So in a developed economy like Japan, people save their money in a bank. A financial intermediary that solves the asymmetric information challenge. Oh, I know. That's hot, right? That's hot, right? When I talk that way. All right. So they save it, and what does the bank do? The bank loans the money, for example, mortgages by people, or, right? I was going to put investment loans, or businesses, homes or businesses, okay? Classic example is the shoe store down the street needs to borrow money because of cash flow concerns for inventory. Totally normal. Think about it. If you go to a store right now, they're selling winter clothes, which means to buy the winter clothes, they bought it several months ago. Okay? Which means they're buying 3, 4, 5 months in advance. So they need the money now. So they go to a bank, borrow money to buy inventory. And a bank will do this all day because they can see the cash flow of the business, the history of the business, but also they loan them money. They loan them $1 million, and they know at least there's going to be $1 million worth of shoes. So if they go out of business, at least they can dump the shoes and get much of their money back, right? All right, so whatever. So this is a normal cash flow loan, and this is a normal long-term investment asset-backed loan. They're both basically asset-backed investments, right? So in Japan, what happens is savings become investment, right? Because the savings are in a bank. Now, if you're in Africa and you hide it under your bed or bury it in your backyard, it doesn't grow. Now, for example, the savers get paid an interest rate. That's cool. And then the banks loan it out and they get a percentage. Okay. And now this turns into productivity and this turns into productivity. Okay. Okay. Or if you don't put it into your bank account, you invest it yourself directly. Now the bank doesn't invest it. What do? Okay. Oh, you buy the stock market. Or the bond market. Okay. Or Forex. And in Japan, Forex is a big thing, or foreign bonds. Okay. Because in Japan, let's say you get 0.5% for sticking it in a bank account. Okay. But if you buy a foreign bond, it might pay you 3%. Okay. Which is also productive. Taxation I don't think is productive. And I don't think any government is capable of anything. And the more they have good intentions, the more they create unintended consequences. At least a corrupt government is predictable. It's the good one that comes in, you're like, well, everybody's poor. Let's solve that. Let's give everybody money for free, and then everybody will have money. And you're like, whoa, whoa, whoa. That's not going to be good on the long run. So anyways, that's my point of view. The savings is better because you can choose. You can make your own investment decisions, or you can have an intermediary make financial decisions. Either way, your money becomes productive. Governments are very wasteful, in my opinion. So there you go. I would choose Japan all day. Now, the government of Japan has made some pretty big bad decisions over the years, but one of their major challenges is the average age of the Japanese citizen. They're expensive and not as productive. Therefore, in an economy like Japan, they just build a bunch of robots. Okay? In South Africa, you don't need robots because unemployment's so high. You can just hire a person. Why would you build a $2 million robot when you can hire 2,000 people for that kind of money? Okay. So I try to keep politics out of our analysis, but instead of just analyze. Okay. All right, cool. So let's go on. Let's do our relative strength. This seems neutral. Oops. Let's do it this way. I'm going to use arrows and I'll make them gray. This looks neutral to me. This looks neutral to me. This is down and up. I'll say neutral. This is definitely down. This is definitely down. This is definitely up. This is definitely down. This is sort of relative, I suppose. I'm just going to leave that neutral, I guess. So anything going on? Pound Aussie, pound euro, pound Kiwi? I guess. Okay. And does this make sense going into a Fed meeting? Yeah. Yeah, it does. All right. So let's take a look. Let's do a pound scan. Okay. Pound, 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 pound. Everything's going good. Okay. And there's a euro in there. Okay, let's get rid of that. And let's open this up. Take a look. By the way, are you guys happy? What a wonderful day. Although I was walking my dog this morning wearing flip-flops, and I went up a hill and then down a hill and then up another hill and down the other, and all of a sudden I'm in the driveway and my legs, my calves are cramping up. I'm like, oh my God. Like I was walking like a zombie, dragging my leg. I'm like, oh my God, I'm going to be late for my webinar. Oh, it was like spikes going through my legs and they still hurt. So apparently I'm not that good with flip-flops. Being Canadian, I was born with snowshoes on my feet, but not flip-flops. I'm that pasty white boy slowly walking across the beach in bare feet because the sand hurts my feet. Hey man, I had boots on my whole life. Actually, I don't think I ever owned a pair of boots, but I had shoes. I had shoes at least. Chinese stock sell-off is in response to Fed tapering. I think it has more to do with regulatory compliance issues. So I was in Baidu. I bought Baidu and lost about 10% on Baidu and just dumped it because the regulatory stuff is hard. I mean, I think Baidu was at 400 and I bought it at like 190, and I think then it dropped very quickly, and I'm like, oh my God. So I had to bail on that, but I don't see that as China's response to Fed tapering. I don't know about that. Okay, be careful, Mr. Sangam. I'm not sure where you get your information. Be careful. Okay. All right, so let's look at the pig dog. What do you guys want to do? Let's do pound Aussie. Man, when was the last time we did pound Aussie? Crazy, right? So let's take a look. We're bullish, right? So let's do position trading bullish bias. Okay, looks pretty. We're already blown through the boom. Already blown through the expected top. Pretty amazing. One of the reasons one of the ways to explain that is how tight June was. Okay? So maybe one trick you could do here is measure the range. Okay? Okay? And you'll see, oh, does the math start to make sense? I mean, dude, how many times have I gone through the pivot point math? You should be able to figure these things out just by looking at the market. You should be able to, in your mind, do things like write your own indicators. Anyways, what would be, how about the previous month? Okay, let's do that. Let's say this is more normal. Where are we now? And there's the low and there's the high. And that's a pretty normal top, isn't it? It's another way of saying if you're trying to compute. So imagine this was a data set. And I say, okay, what is the distribution of these data points? And first of all these data points, what is the average data point candle by candle by candle? So starting here and starting here and starting here. And you might do something like, oh, so Wayne, based on the information you just asked, from this period here to this period here, this is the mean. And I say, that's cool. But what we're trying to answer is y, not GDP, but y-axis. Y equals mx plus b, where m is equal to the slope of the mean, slope mean slope, which is equal to the rise over the run. So now you say, well, here's the run over this period to here, you get a slope, rise over run. Okay? And what does that tell us? Well, from this period of time to this period of time, okay, the slope of the mean is positive. It's bullish. Okay? Now, the next thing that what you want to do is look at, okay, there's an up, there's a down, 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 there's an up, okay? And you look at this and say, well, when price deviates from the mean, the trend mean, how far does it deviate before it reverts back to the mean? So what we're kind of interested in here is, when does it revert back? When does it revert back? Okay? This is what we're trying to figure out. And statistically speaking, your measurements would tell you, well, remember, it doesn't predict, it's just answering your question. In the past, how far from the mean does price deviate? We call that a standard deviation. And we are approaching this. Okay? So, does that mean it's going to fall? No, not necessarily. It's just telling you statistically, in the past, we're at a point of potential deviation, but maybe there's new news. Maybe there's new information. Maybe this is a new market. Maybe. It can do whatever the heck it wants. Nobody really cares about the standard deviation because, as all statistics will tell you, is if this skyrockets up to 2.0, well, then the standard deviation will change. It'll widen. So it doesn't create the trend creates the deviation, right? So anyways, but it is a point in which you say, oh, this trend is very, very bullish. Should I be concerned about it being overbought? Cool. So now you change, right? Now you change. Let's take a look from a different point of view. Okay? There's a lot of information here. This is, okay, August profit zone. If you're a bull. Okay? Which is 1.93. Okay? Cool. Does that mean we're going to go there? No, that's not what that means. If you're a bull, that's what you would normally be targeting. Now, typically in Wayne's world, we don't really get there in August. So whether it's right or wrong, in the back of my brain, so now I'm talking trader psychology here, I'm thinking like this. Now, this is a cross pair, so that may not be the normal thing to look for because 99% of my trades have $1 on it or a yen on it. So does this cross have to do this? No. So I'm going to take that back. This is just relative strength. It can do whatever it wants. Okay? So the next thing is, if that's our target, how can we use price action to get there if this is our target? By the way, if you're enjoying this conversation, would you please have the courtesy to click the like button? I'd appreciate that. Okay. So one of the things that we would do here is, once again, take a look at our tools. Okay. Price action is a great one. Moving averages are a great one. So let me project out some moving averages here. Probably about, okay. How about this? It has to go up and to the right. Okay. Up and to the right. Okay. Okay. Well, once again, Mr. Sangam, I want you to focus on The information I share with you have to do with seasonality of these. But a cross rate, it'll do whatever it wants. Okay? Remember, there isn't necessarily a long-term fundamental play here. I mean, there can be. Pound could be long-term fundamentally strong and Aussie could be long-term fundamentally bearish, but I believe that they share an indirect relationship with global macroeconomics that wouldn't always make that true. So therefore, I believe when you're doing relative strength, it's much shorter term. It's not long-term macroeconomics and central banking, divergent central banking policies and stuff like that. No, right now, pound is strong or Aussie is weak, or more likely, both of those. But that doesn't mean that's true, generally speaking, for the long term. So you have to separate from all of that, okay? So my macroeconomics is going to lead to, really, what is macroeconomics the study of? Flow. Now, of course, I'll tell you in the beginning of a macroeconomics class, macroeconomics is the study of choice. Okay? Does your economy produce motorcycles, cars, or both? Okay? That's a choice. You have a big economy with people and tools, so you can make a lot of different things. It's the choice you make, and the reasoning behind the choice is what macroeconomics is. But what's the consequence of that? Well, if there's global trade between your economy and other economies, then what we're tracking as macroeconomists and thereby foreign exchange traders is the flow of money and goods and services over a border. Because remember, if one country is buying goods and services from another, they're importing the goods and services, but they're exporting their money to pay for it. And so we're tracking that. Okay? So that's why I back everything up with solid macroeconomic reasoning. Okay? Cool. So anyways, if you're using your moving averages, then you're making decisions like this, that it will probably work its way up. If that's your target, you have to now make some assumptions on the price action. And this is the visualization ex ante to trading. Okay? You visualize this first on a 4-hour, and then you say, well, in that case, what would the next 2 days look like? And what would the next week look like after that? Okay? So how will Wednesday, Thursday, Friday look? And how will next week look? And you say, well, okay, if it goes up some more, then next week it'll come down. If it comes down some more now, then next week it'll go up. So you could say, one theory is, okay, we do this, and then we have a red candle tomorrow, and then maybe a stabilization Friday, and by Monday we're here, and Tuesday we're here, and Wednesday we're here. And now you're kind of planning where the week looks like this right now, then it'll look like that, and then next week will look like that. And that would be the first leg of a multi-leg journey to your target of 193. Do you see the process of planning? Do you know if that's true? Well, look, if you're staring at your charts and something else happens, then you're like, well, plan A is dead. So for example, let's say the Fed meeting, the announcement happens and the press conference happens, and instead you have a big green day. How will next week play out? Well, then you plan that now. Plan that now. Think ahead. So if we move sideways, what will the market look like, and how will you want to behave next week? If the market retraces a little bit, not crash, how will you plan next week? And if it rallies, how will you plan next week? What's up, Travis? Vesta Welt. Okay. You see the process of planning? Okay. So here's what I just said from a different point of view. Comes down, you buy it here, and you go up. We call that a swing trade. What did I just do? We're using this monthly as a top and this weekly as a buy. No real price action, but you'll see if that actually occurs, you'll see that this 21 will have caught up by then. Okay? Gut ist gut, yeah? So, how do you feel about, let's just do day trading, I guess. Let's do day trading on a 5-minute chart. Okay? How would you try to fit that in? Well, you'd say maybe today we get to about here, and then we come down a little bit, and then up tomorrow. And this is probably an Asia fade. So like, for example, we kind of miss around here, and then there's a big Fed meeting this way, and then a counter this way. Okay? Or something to that effect. What do you think? By the way, I've taught you many times how to day trade. Okay, check this out. Check this out. Okay, and this is elevated, but anyways. This one is tougher, but these are great. There's some good trades here. Okay, if this is what you're trading. Now, of course, Pound Aussie is not one that I'm staring at all day, every day, but I'm trying to break this down into digestible pieces. Okay. Well, Charlie and Batu say, hey, how about pound dollar? Well, pound is ripper strong and dollar is moderately strong, so why would we do that? Okay. Okay. To me, it seems like some of these things are at elevated prices. Okay, so this is basically, let's call this R2. This is R1. This is S1. This is R1. Okay. You can see some of these are starting to look heavy. These are daily pivots. These are, I think, weekly pivots. Okay. So let's put this back on weeklies. Pivot points weekly. Okay. And this has blown the doors on that. Okay. So everything looks like maybe that. And that's the problem with relative strength. It only tells you what has been happening, but it doesn't tell you if it's going to continue. And two things can go wrong. Pound could get weak. Actually, three. Pound could suddenly get weak. Or that Aussie, for example, can suddenly get strong. Or a combination of both. And those three things can really hurt you very quickly. I don't prefer, is the better language. I don't prefer relative strength because it's hard to explain why it'll be strong tomorrow. I can only tell you it has been strong overnight, for example. But why would it be strong tomorrow? I'm like, I'm not really sure. Okay. Where a fundamental thesis would help me explain why, for example. Why would WTI go up? Okay. Well, I could explain that. Okay. And since I have explained it a million times, I'll leave it at that. Right now, nothing's happening, so I wouldn't be eager to get involved. Okay. Okay. Interesting though, right? Where you have a top, lower low, lower high, lower low. Now, you can see there's something going on here. And there's a war going on. Now, really, it's because nobody's trading, but it looks like a war. If this was September and you had something like this, you would see bulls and bears in the pit with knives, right? And bats, right? And they'd be fighting it out. Really, nothing's happening, okay? But the point that I'm trying to make is that this is definitely in play here, and this stuff is definitely in play here. And what comes next is sort of important technically, but fundamentally, I think this will be at $100 in a year. Okay. Mr. Sangham says, hey, if you become a Harvard professor next year, look, I am going to become a Harvard professor, but I'm not going to do it I would do it for fun, right? I probably make more money than a Harvard professor in 2 weeks than a Harvard professor makes all year. So, I'm not going to become a Harvard professor. But I'd like to teach summer school. Yeah, when the markets are slow. Yeah, I'd like to teach either a 3-week class or a 7-week class of macroeconomics and, let's say, capital markets. Oh, I'd love to teach a class like that. Yeah, that'd be great because nothing else is happening. I get to live in Cambridge and nobody's going to laugh at me for being a Harvard professor in economics. They're like, really? That sounds stupid. Okay. We would never hire somebody like that to advise us on our fund. I mean, dude, they hire you because you're a Harvard professor. Right? So anyways, yeah. So would I still do these webinars? Look, I went to Harvard how many summers in a row? 3 or 4 summers in a row. I did my live streams. Okay? I was just in northern Wisconsin. I did my live streams. I was just in Florida on the Gulf of Mexico. I did my live streams. Right? I've been around the world and I always do my live streams. Yeah. So anyways, yeah, I'm here for you, bro. Okay. Coolio, right? But yeah, don't worry about that. It's all good. That's what I do for a hobby. Okay. Are there examples where major trade partners make cross pairs long term? Well, like there have been times in history where like I traded more Swissy in 1 year than maybe every year. And then Aussie, like, let me give you an example of Aussie. Who wasn't it? It was Governor Stevens who ran the Reserve Bank of Australia. And when he was in charge, the Aussie was falling. And so I would be, selling Aussie dollar and Aussie yen. Okay. And then Governor Stevens came out, and I'll make up a number. Let's say we're at 93, whatever that means. I have no idea. Okay. But anyways, let's say it was 93 cents. Then Governor Stevens came out and said it was only worth 83 cents. No joke. And so I quadrupled the amount of shorts on these pairs, but then I shorted Aussie versus everything. Okay. Pound, CAD, Euro, didn't matter. Kiwi. Okay. So on and so forth. And there was a reason for that. So these are cross pairs, but I had a fundamental reason for one. Okay? So basically I create an index where I just short Aussie versus anything and everything. Okay? Mr. Sangam says, yeah, I live streamed live from Hong Kong 2017. Yeah, I was there for like 2 weeks at the club level at the Ritz-Carlton. Has anyone lived at the Ritz-Carlton for 2 weeks? Yeah, that was fun. But just not, I think around that time, what year was I in South Africa? Live streams from South Africa. So anyways, I don't look to have days off. Okay? Have I taken a day off this year? I don't think so. Anyways, so in this situation, and by the way, when we got to 83, he said it was 73, and we just continued selling like crazy. So I always have a macro fundamentals policy, and then in that case, I right? But when the pound is just being the pound, and the Aussie is just being the Aussie, then one just happens to be strong today, and the other one happens to be weak today. But not many people are actually trading the pound Aussie. You have to understand that too. Mr. Sangam, I'm not necessarily committed to the webinar. I'm committed to your success. Okay? But anyways, you have to understand that money, let's do this color. Money in Great Britain is going to its trading partners and from its trading partners. How much of it is actually Australia? Money is going from London to Sydney or London to Melbourne. Dude, percentage-wise, forget about it. Hardly anything. And so amateur currency traders will get on, will find like pound is strong today and Aussie is weak today. So they're trading that, but they're overstating what's happening. It's like observing a black hole. You can't actually see the black hole, but you can see how space around the black hole is impacted, and then you can make certain assumptions of where's the black hole, how big is the black hole, that kind of stuff, but you can't actually observe it. It's like nobody is actually trading pound Aussie. Or the few people that are, it's very minuscule to what is actually happening. So you see a bunch of green and red candles and you think green candles are people buying and red candles are people selling and everybody's on this pound Aussie. I'm like, whoa, 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 whoa. Green candles could be bears taking profit. Red candles could be bulls taking profit, which is quite different from what was just hypothesized. And by the way, the pound could just happen to be strong in general, and Aussie could just be weak in general. But if you don't understand why, then it could just easily stop. Right? It could just easily stop, and you're like, whoa, whoa, what just happened? And it's because you're making assumptions using technical analysis now. Think about this. You're observing pound Aussie moving up. So you're like, oh, well, people are selling Aussie to buy pound. That is not necessarily true. That's the first point I'm trying to make. The second one is then you start making bullish assumptions, buying dips and stuff, and then all of a sudden out of the blue, it just collapses on you. And you're like, what the hell? What just happened? Well, you were making technical assumptions from your observation of a pound Aussie that were indirect observations of what was actually happening. You didn't see the black hole because there's no black hole to see. Statistically speaking, no one cares, right? Nobody cares about the pound Aussie. They care about the pound, they care about the Aussie, but you're observing it through the lens of pound Aussie, but no one else is looking at that lens. So now you're making assumptions like, well, I can kick it off this moving average, I can kick it off this pivot, this role reversal, and much of it is somewhat true, but a lot of it is somewhat coincidental because you're indirectly observing what's actually happening. The pound is strong, the Aussie is weak, but how much capital is flowing from pound to Aussie or Aussie to pound? Nothing. So be careful. This is why I don't trade crosses as much, but if I do, I'm just scalping. Hey, it'll probably, well, I can't even say that. I can't even tell if it'll probably be the same for the next 2 hours. I can only tell you that it has been such a way for several hours, but several hours more, I can't really tell you that. Okay? But when I'm looking at pound dollar, pound yen, maybe euro pound, there are fundamental reasons why big amounts of money is flowing from Europe to Great Britain. Okay? There's major reasons for that. And that's what I'm trying to grasp. And that's what I'm trying to trade, because I can tell you there's a lot more pounds and euros being traded than there are pounds and Aussies. For example, let me just make up numbers to make my point here. What if versus Great British Pound, okay, there's 800 billion pounds of euro being traded every day, but only 75 billion of Aussie dollar traded every day. Then the Aussie part is pretty weak. You have a weak observation, but versus euro, it's a strong observation. And I would trust the technical analysis a lot more versus the euro than the technical analysis on the Aussie, because it'll work while it's working and then it'll stop working. And you might not have the skills to stop trading. And you'll say, well, but yesterday, blah, 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 blah. Dude, that was a coincidence, sort of. Not really. Some people are going to get very upset by this, but it wasn't actually happening. Maybe a lot of pound was going to Europe, or a lot of euro, for example, was going to London. And that made the Great British Pound strong. And a speech by the RBA drove the Aussie down. And you're trying to trade pound Aussie, but like, dude, there are two independent variables going on here, and you're trying to collide them into one investment thesis. But those are two random variables you're putting together, and it may not add up. You see, did I hit it there? Did I get it out right? Do you understand? Two independent variables, and you're using it for a trading logic. Why wouldn't you say, well, why is money leaving Europe and going to the UK? And that would be a more direct observation of a real variable. Okay? Or vice versa. Okay? So be careful. People look at charts and they say it's all there. It's not all there. When people say it's all in the price, what they're trying to tell you is they don't understand. I want you to think about that. When they're like, oh, you don't need to know fundamental analysis of macroeconomics. Everything's in the price. All they're trying to tell you is they don't understand. Right? When somebody says you can't scalp for a living, and I tell you it's not the best way, but when they tell you you can't, it's because they can't. So never listen to somebody else. Okay? This is why I'm trying to teach you how to make your decisions. If you go to a YouTuber and you're trying to get investment decisions from a YouTuber, you have serious delusions. Right? That you have serious problems. Okay? So instead, I'm trying to teach you how to make valuable decisions yourself. Okay. And I hope you appreciate that. All right. So we're at this point of you're a bull or a bear. And one of these two scenarios is going to happen. It's funny because I got three scenarios. One of those two scenarios is going to happen. The thing is, you're not trying to predict it. You should probably let it happen and then have a response. What would you do if you're a bull on oil? Okay. Well, you say, well, if the pink one happens, I'll buy the dip. If the black one happens, I'll buy the 1, 2, 3. Both are bullish. This is plan A. This is plan B. Okay. And as it says in The Art of War, an honorable general wins. Sorry, an honorable general is victorious because many plans are made. Mahir says, but Wayne, you're a YouTuber. Yeah, but I don't give you advice. I teach you how to think. I teach you how the market works. I teach you what information is important. I teach you how to think about it, analyze it, compare it, and construct it both fundamentally and technically into a trade plan so you can carry out your trading strategy. I'm trying to turn you into a professional, whether you trade for a living or you trade other people's money. Either way, I'm trying to teach you how to create value. But if some YouTuber told you to buy pound Aussie today because it was strong and they put you into a trade, that's just dumb. Right, Jimbo? So I care about you. I want you to succeed. Okay? Right? So if some YouTuber is making $500 a month or $5,000, I don't know, whatever. Let's get off that. All right. So, off we go. Are you a bull or a bear? Okay. I have seasonality in this, so I'd like to maybe come down so I can buy it later. See, that's how a boss thinks. I want this to come down so I can buy it. Charlie says, so you can fix stupid. I don't know if I can fix stupid. Huh? Depends on your mommy and daddy, I guess. All right, gold. It's just getting tight. That's all. Okay, this is going to move after the Fed meeting. We're going to learn more about the Fed, and I'm happy for that. Okay. Michael says July and August central pivot points are practically the same. The waiting idea. Once again, I'm going to say it for the millionth time. Seasonality. Okay. So I've already prepared you guys for this. And when the pivots are crappy, when you get really pathetic pivots, okay, maybe like you were saying, like Michael's saying, like one pivot point's here and the other one's here. Well, in this case with oil, we have a pivot here, and which sucks if you're bullish, okay? And whatever it is, or you're here, and it's really tight. And then next month compresses. And you're like, man, this doesn't look good at all. Okay? That's when people get into trouble. When they're using the tools to try to figure out what's going to happen next. That is not the correct use of technical analysis. Okay? Your job with fundamental analysis and your understanding of market cycles. Just things like going from Fed meeting to Fed meeting to Fed meeting to Fed meeting. Okay? Simple things like that. Once you understand the ebb and flow of our industry, of just being in the business, okay, then you can coordinate some of your theories. So one theory would be the long-term impact of the fiscal and monetary policy of the United States and what flow that will have on the US dollar. Flow into the United States or flow out of the United States. That's your long-term thesis. Now, the second one is, what are the shorter-term impacts of changes in fiscal and monetary policy, and when are they going to happen? Because you're trying to figure out the ebb and flow of the year. So now you can say, well, I don't think it's going to happen in July, but I think it'll happen in September. Well, how do you know that? Well, I don't really know what the Fed's going to announce, but I have some basic assumptions on using things like seasonality. Why do it in July? I think they'll do it in September. Okay, great. And then you start incorporating now technical analysis. Where are we in that cycle? When can I expect volume and volatility to increase? When can I expect volume and volatility to decrease? And when they increase, is it likely to go in the direction of my fundamental bias? And when would that likely happen? So you're like, well, maybe the third week of August, I will be at my desk ready, willing, and able to use technical analysis to confirm things like, are we at support? And then the next thing is, has this market reversed? And thirdly, has this reversal taken hold in a new trend in the direction of my fundamental bias? And if so, how can I crush this 10 times a day? Which is a lot different than, do I sell now? The central pivot drop from here to here. Does this make me a bear now? Okay, no. Whoa. Okay, no. Okay. Neat, right? Can anybody describe to me the reasoning of why gold rallied? Okay. In particular, let's do from here to here. That's the big one, because you can see there's a giant acceleration. So that, okay. Why did gold, okay, look at the incredible acceleration. Why did gold rally? US dollar weak. Wrong. Much of that time, the dollar was strong. Fed intervention. Not the direct answer. Fed didn't drive up gold. You think the Fed bought gold? No. Mike gets partial credit. He says India buying. Central banks around the world that were negatively impacted by the flow of capital, money flow, towards their economies because of the COVID crisis. Again, the COVID crisis was borders closed. People are not allowed to go to work. They're not allowed to go to, right? So they need cash to survive. They're locked up in their apartments. They can't go to work. They can't earn a living. Oh my God, how are we going to buy food? How are we going to pay rent? Savings. Okay? Much of that money is parked internationally. So they bring the money home. When you bring the money home, the flow is toward your home country, like India was a great example. Israel was another. Okay. Okay. Money was flowing to the country, which means they had to get out of the foreign currency into their domestic currency, and the domestic currency went up in value. Now, this would be bad for an economy like Japan. So, the Central Bank of India, for example, okay, we'll take this one. The Central Bank of India says, all right, the rupee is strong. We don't like that. This is bad for India. Okay? And if you don't understand why, you'll have to do some more studying. Okay? So if the rupee is going up in value, and that's bad, what can the Central Bank of India do? Well, it has a balance sheet. And it's not a reserve currency, so it can't just do what the Fed does, because the Fed's debt is its own currency. India can't do what the Fed does because it couldn't do it. It just can't do it because it's not a reserve currency. So they're like, all right, we have a balance sheet. We have some cash, and we have some assets like, we'll just put assets. Cash is an asset, but let's just, well, you know what? Let's do it like a balance sheet. Okay, let's do it on the asset side of the balance sheet. So I'll have to kind of restructure this. Okay, let's do the balance sheet. All right, so at the Central Bank of India, there's a balance sheet. Okay, you have assets and liabilities. Okay, cool. And, okay, so this is bank deposits from all the banks in India. And this is in a form of cash. Okay, now, what India can do is convert some of this into gold. So instead of 1 billion in cash, they can sell 500 million, 500 million, okay, and instead buy 500 million in gold. What's changed at the balance sheet? There used to be $1 billion in cash. Now there's 500 million in cash and 500 million in gold. How much has changed at the Central Bank of India's balance sheet? And so this would be 1 billion in bank deposits. Okay? Okay? So what happened was the bank sent 500 million rupee into the Forex market, increasing the supply, lowering the value, okay, and then brought gold in, driving up its price. Okay? That's right. So John says, well, the rupee went down. This is the period where rupee went down when gold went up. Okay? That was the central bank stepping in. There's no other reason, John, for them to have done it. Now, in about this period, I told you guys here at Forex.Today that in this period here, okay, the Reserve Bank of India's gold deposits had increased to a record high. The RBI had never bought so much gold in their entire history as a central bank. So I was trying to tell you guys, Why? And it was the RBI and other central banks, this wasn't all India, but other central banks in a similar situation that needed to maintain their balance sheet, but lower the value of their currency. Okay? You're welcome. Okay? You're welcome. Cool. But now you get it. Now you got it. Now you know it's good. My rhymes are tight. You wish you could. Okay? Well, John, think of it as a central banking tool. Okay? Think of it as a central banking tool, and that, you know, if the RBI, I mean, the RBI could hold it forever. Okay, John? They could hold it. It's a legitimate near money asset. It's not M1 or M2, but it's still near money, like, or pretty close. And it's something that central banks hold anyways. And Indians love gold. I mean, look, if the central bank says, oh, we got, 500 billion in gold in our vault, dude, Indians like that. It's all good, right? Like, that's legitimate. And stable, and other central banks would consider it stable. Like, they may never sell that gold. Okay, John? And that indirectly is supportive of gold. For example, if they dump all the gold they bought, well, now gold prices would collapse again, right? But why would India do that? Because if they sold off all their gold, then they would strengthen their currency, and they just bought the gold to weaken their currency. So they never actually, right, John? They never actually want the rupee to get strong ever. Because it's an exporting country. So they may never actually sell it unless they need the cash. But I don't think we're going to get there, right? So they may never actually sell it ever again, which is supportive. And by the way, at the time that the Reserve Bank of India was doing this, the Reserve Bank of Israel was doing this as well. And I can tell you many other central banks, around the world needed to do something similar. And that's why gold prices went up. So your question, to directly answer your question, John, will we ever get a higher high? Well, that's where inflation comes in. Now, people will say gold will go up because inflation will force people to buy gold, right? No, dude, they already bought gold. There's no sellers of gold, right? Those central banks may never sell that gold. So we can kind of say that gold is never available again. Not in the foreseeable near future, right? So there's no sellers of gold. There's only buyers of gold, but there's no gold to buy. So what would make prices go up? Well, if the price is in dollars, the dollar will fall. People will say, oh my God, that's inflation. And that's why gold's going up. Yeah, well, you just saw a black hole. But hey, you can't see a black hole. Right? You see that idea? You're like, you just told me you saw a black hole, but you cannot see a black hole. So what is it that you saw? Oh, well, I saw the light bending. Okay, great. You saw light bending, and now you theorize that it's a singularity in the space-time continuum. Gotcha. But you didn't actually see it. You observed something else indirectly. So gold going up won't completely be indirect, right? There'll always be some buying and some selling, but very few people buy like billions of dollars of gold at a time. Okay? Now, I have met people that own tons and tons of physical gold and have warehouses of their own. They own the warehouse, right, of gold. Tons and tons and tons. And they could always sell when they need cash and all that kind of stuff. But a central bank, think of it just this way. central banks own gold, and many of them may never need to ever sell the gold they already own on their balance sheet. And that would be indirectly supportive. Okay? And the more central banks buy and the less they ever sell, then that's just indirectly supportive. And now what you're really trading is near dollar. You might be selling a weak dollar, okay? And then you say, someone else says, no, I'm selling inflation. Okay? And I'll tell you, no, I'm selling growth. Okay? And someone else might be selling productivity. And someone else might be selling jobs. Okay? And to me, they're all the same. Because inflation is growth. Unless you're in stagflation. And that's a problem. Okay? I know there's zygote out on the street about such. All right. I don't think we're there yet. But there is productivity. Okay? And we are hiring people. There are jobs. Okay? There is growth and there is inflation. And all of this will have impact. Okay? To me, it's all the same thing. Okay? What you don't want is inflation greater than productivity, or inflation greater than growth, or right? These are I's. You don't want inflation to be higher than GDP, for example. Whatever. See, to me, they're all the same thing. So whatever hits you. So what is GDP going to be coming up soon? Annual GDP, what? 4.5? Okay. And how high is inflation? 3.5? I is less than GDP. So it's all good. It's all good, my friend. Okay. VIX. I have a question here, and I think I'll make this the last question of the day. What is VIX? VIX has to do with insurance policies. Okay. Traders hold the S&P 500. What if you felt like the S&P 500 was going to drop 5%? And you own $3 billion in equities. What are you going to do? Sell your $3 billion? Hell no. But you're worried that there's going to be a 5% decline. Do you eat a 5% loss of $3 billion? Dude, $150 million? Because you're just going to eat a $150 million loss because you're not boss enough to do anything about this risk? And then, of course, what if 5% turns into 15% because of stuff you didn't see? It's worse than you thought. Well, shiza. You can't just ignore it because people pay you money to not ignore it. So what do? You buy insurance. What kind of insurance can you buy on the S&P 500 futures contract? Ronald says start selling gently. Never. Never sell. You're a money manager. You hold it forever and get paid for doing nothing. You buy options. Cool. So the VIX. Oh, let me explain this one extra step. So we're talking about one fund now, And if they're a little bit worried, they buy some options. If they're very worried, they buy more options because they'll need more options to cover, right? So like if they thought there could be $150 million draw down here, they can buy enough options on the S&P 500 that makes money on the way down to cover what they consider 150 M of risk. But what if it potentially could be this much? Well, then, they might need 450 to 500 million because this is leverage too. So they do all the calculations and say, well, if we're right and there is a 15% decline, how do we make up our $150 million loss or our $500 million loss? So one firm might think it's a 5% risk. The other one might say it's a 15% risk. Another one might say 30. And another firm might say there's no chance in hell this is coming down. So now it's all these hedge funds and wealth managers saying they're analyzing the near future of the S&P 500. And they're like, how much risk of a decline do we face in the short run? How much will it cost us if it did happen? And how can we use options to ensure if it does happen that we're covered? So an option costs you a little money to buy. And if you're wrong and the S&P 500 goes up, it costs you a little bit of money, but it's no big deal. And if your client says, well, what was this small little loss here? Oh, well, this was insurance to make sure your money wasn't at risk. Oh, okay, I get it. And it's so minuscule, it's no big deal. Okay? But if the market does fall, you get your 500 million. And now your loss in your cash is made up here, right? So you lost 500 million in cash on a 15% decline, but you had options and you made 500 million on your options, so you were hedged. Hey, guess what? You're a hedge fund. Cool. That's how that works. So going back to VIX, what the heck is the VIX? The VIX is showing you an index of, are people buying options to protect their S&P, specifically S&P 500 positions? Are they buying a little bit of options, a lot, a very lot, or none? Someone might buy 0%. Okay? And what we're looking at is how much demand is there for options used as insurance to protect cash positions in the S&P 500. And if the VIX goes up, everybody in the world is buying options. And if they're coming down, they're not buying options. They don't need the insurance. They're like, why would you buy insurance? Why would you buy flood insurance when you live on the top of a hill? Do you understand? Why would you buy fire insurance if you live in the middle of the desert? There's no trees. Sand don't burn none. So you're like, what's the chance my house is going to catch on fire? Why would I spend $10,000 a year insuring my house when there's like a 0% chance? So you're like, I'm not going to buy fire insurance. You understand? So in this case, if you're very fearful, you're going to buy a lot of insurance and the VIX goes up. And it's not you, it's the market. Is there lots of demand for options for specifically the S&P 500? And if so, there's fear of a retracement. But guess what? They're not selling, are they? Okay? Interesting, right? That's why they call it the fear index. Okay? And by the way, Bill Ackman, when he started to get worried about COVID, bought a huge amount of options. Huge. Made a huge pile of money. So let's just say he made $5 billion in options. Okay? lost 5 billion in cash positions because the value of his stock portfolio went down, but the options made 5 billion. So he still had the same amount of money because it was a great trade. He protected the cash for his clients, but then he was holding this 5 billion in cash. The value of the stock portfolio dropped down by 5 billion. So what did he do? Then he bought the stock market back at 5 billion. Okay? And then it went up and then to an all-time high. And in a matter of days, he made billions of dollars of profit for his clients, where so do you remember our friend Ray Dalio? Ray lost money. He said the market's going to crash, 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 and then he lost a whole bunch of money. Bill Ackman just did his job. He made money. Right? So anyways. Hey, I hope you're going to be there, Hope. Okay. Yeah, by the way, Michael's asking a very specific question about Japanese year end. And yeah, the correlation has been changing for sure. Okay. So yeah, you're right. Okay. But if you go back to, well, let's go back, I think. So I don't have the data that you're saying that you have, but there is a dollar-yen turning point. Okay, let me just address this and we'll be done. There's a turning point in the year. Actually, well, of course, there's two turning points in the year, a top and a bottom. For USD, Japanese yen, or in this case, Japanese yen, USD. Okay. And you can go back 30 years or 20 years, 30 years, 50 years, whatever. Okay? Jimbo says, Dalio said 21, 22 for the correction time frame. No, he lost money on the COVID play. Anyways. Okay. The turning point, Michael, you ready for this? Is in the early weeks of April. Now, that's an average, which means sometimes it could be the late weeks of March, April 1st, or a couple weeks after, or even near the end of April. But there's definitely an important point right around April 1st. Now, I can't prove anything, right? It's not like I can say the sun makes the atmosphere hot and for some reason humans like to consume ice cream. I can prove the sun's hot, but I can't prove like why people eat ice cream. And is that universally true? Some people don't even have food to eat no matter how hot it gets. Okay? But my point is I can't tell you why, but I can make some guesses on a relationship and causation. And I can say, well, right around April 1st, we'll call it March 31st, right? April 1st, fiscal year end in Japan. And this is when CFOs have decisions to make on when do they pay taxes. Now, I've seen it when tax policy changed in Japan and unequivocally changed the flow of capital for the Japanese yen based on whether a CFO wanted to pay low taxes this year or higher taxes next year. And they said, well, we need to move the money here anyways. Let's move it here sooner than later. Okay? But I can only guess. Now, what I'm trying to do and where I come from with my point of view, because I'm not telling you I'm right. So I can only tell you my point of view. I'm a businessman. Okay? I'm a businessman. Okay? I'm a businessman. This is where I come from. I come from the world of business. And I think there's logic. I'm a believer in Newtonian physics. Okay? That a hammer dropped and a door opened. A sprocket turned this way and it made the other sprocket turn the other way based on the diameter. Okay? Or the radius. Okay? Cool. So in this case, I look for a logical business reason. And even if it's full of crap, I'm still trying to apply logic in a way that I understand. So maybe my point of view of taxation and all this kind of stuff is total nonsense. I say, well, I see CFOs at major corporations in Japan. And by the way, Japanese businesses are multinational exporters. They are all impacted by foreign exchange taxation, which means, think of it this way. There's Toyota and Honda in the United States, but they're still owned by companies in Japan. And the company in Japan can say, you know what, bring the money home. Why? Whatever, who cares why? Now, when do they make these decisions? They have board meetings at the end of the quarter, at the end of the fiscal year. There's reasoning for that. There's taxation reasons for that. There's all these different reasons why. Okay? Also, there are humans in Japan that have money invested overseas. And there may be some other seasonal. Maybe the cherry blossoms in Japan make people bring money home from foreign investments, bring it home to Japan so that they can buy gifts for each other. I don't know. I'm not Japanese. So I could say, oh, look, it's taxes, it's CFOs. And someone else say, no, it's the cherry blossom festival. And someone else might just say something else, and we might be all somewhat right. The thing is to understand when the weakness turns to strength and when the strength turns to weakness, and when to pay attention and when to sit up and take notice and when to prepare and anticipate changes in the market so you can make informed decisions. But this is another example of I can't see the black hole, but I know it's there. Okay? I know there is a singularity in the space-time continuum. It's just not observable, but I know it's there, and I can see it by how light bends. And from that, how much the light bends, I can do basic measurements and make assumptions of its size and strength and even direction. Is it going left or right, toward us or away from us? I'll need to do many calculations, at least 30, and then make basic assumptions on that. But I can never actually see it. Okay? Cool. Well, all I can say, Michael, is great. Good for them. Okay? Good for them. I'm glad they did their research. I'm glad that's their alpha. I hope they make good investment decisions on behalf of their proprietary money as well as their client funds. Good luck to them. I'm happy to have them as market participants. Good. That's all I can say. Good. They did their research. I have my research and assumptions and experience. I don't know who's right, but I know I need to constantly be aware. And I'm actually redoing it right now. I'm hiring someone to do the study right now, in fact. Okay. Oh, it's not weird. Okay. all I can tell you is, in my opinion, they haven't figured it out yet. That's not my problem. Okay? Great. So thank you for being here. Thank you for being part of the Forex.Today YouTube community. Thank you for being a client of tradersway.com. Thank you for all the hard work, the great questions. Remember, please take notes, and then in about 12 seconds, you'll be able to refresh your page and leave a comment under the recording of today's session of what your key takeaways were. Thank you for being here. See you tomorrow.